Folks, the famed Tom Lee of Fundstrat is out with his latest predictions, warnings, and one stock that he suggests you must buy now. For those of you who are wondering what's going on with this current market panic and want to figure out how to make the most of it, well, this video is for you. In today's video, we're going to break it all down. And as always, if you're the one taking the ultimate risk, you got to be the one doing the ultimate frisk. Always do your own due diligence on all ideas presented. Also, quick plug, if you're wondering what broker is the most powerful to trade stocks and options on, I'll put a link to Moomoo down below. They have an excellent platform and they're offering up to 30 free stocks for our viewers. Pretty good deal just to try them out and deposit a little bit of moolah. And also, quick reminder to celebrate our massive Palantir winning calls that went up about 1,219% alert price to highs. Well, we do have a Palantir 75 coupon code, which will get you 75% off our program. Palantir and some other plays are selling off right now, and we are preparing very aggressively for what we believe could be a big total rinse and repeat on this stock and many others. You're going to see a lot of really nice alerts sent out over the coming weeks, and you're not going to want to miss out. So I'll put the link to that down below if you want to take advantage. So let's go ahead and start with market data. Fundstrat went and tweeted this out. This is a chart of the different so-called market crash catalysts that ended up just ultimately getting bought up. You had the DeepSeek scare, which panicked investors and then boom, recovered. Then the tariff scare, which panicked investors and then recovered. And then the hot CPI scare that panicked investors and then boom, recovered. Now they are suggesting that all of this is just going to happen again. This time around, we're getting a little bit of all of those and the tariff threats are back. But overall, Fundstrat believes and Tom Lee believes that this is going to be a dip that gets bought up and we go to a new all-time high. You can let us know your thoughts down below if you agree with them or you don't, but this is what they're saying. Let me show you more evidence for this. You look at MTOM, which is the iShares USA Momentum Factor ETF. It's down about 5% right now. And keep in mind, in the last 7 months, we've had 6 pullbacks that were 5% or more. And those ultimately culminated in another big boomy McBoomy right after, right? And of course, when momentum is in a pullback, that means you're going to be finding better deals, especially on growth stocks. High business growth, high stock appreciation growth, stocks tend to have the best deals during these momentum pushbacks. Remember, growth stocks with high momentum in the business and chart, move much faster than the rest of the market. They do way better than average when overall momentum is strong and way worse than average when overall momentum weakens. And Tom Lee is saying that's something that we're seeing right now as stocks sit at all-time highs. We're seeing a lot of big growth names pull back a lot just because that's how they move. Just because they're very momentum dependent, right? They do very well when people are going risk on. And whenever momentum dies off, people start panicking. Right now, we are in a period of net bearish sentiment. The American Association of Individual Investors were asked what direction they feel the stock market will be in the next 6 months. And the final result was that we're seeing a net bearish sentiment, negative 11.3. Now, if you look back at history, though, there's only been 11 times since 1987 where investors were this bearish within 1% of 52-week highs. And if you look at the average forward return for the S&P 500 when this happens, well, the average return over the next 12 months is 9.7%, the median is 11.3%, and the win ratio is 82%. So what exactly does this tell us? Well, it tells us that the fact that we have these sell-offs, that we have these skeptical walls of worry and fear, that we have these cool down periods, well, that tells us that, hey, this overall uptrend is actually pretty healthy. It's the unchecked uptrends, the ones that don't breathe, the ones that don't have any worry or questioning, that tend to be the ones that get ripped from the market fastest. The minute that everybody is net bullish and no one is questioning is the minute that we are heading for overheating and heading for a crash, right? And this is the case that Tom Lee is laying out here for why he and his firm don't believe we've hit a top yet. He also thinks that because of all this tariff talk and the softening of consumer sentiment, well, he thinks all of that is going to lead to a higher probability of more rate cuts this year than markets have priced in. And if you look at the Fed futures, that is being backed up a bit by overall markets as well. So overall, Tom Lee's message is remain bullish and buy the dip. Quote, more broadly speaking, we do not think a major top is in place. We discussed 3 reasons last week for our view, but the first one below is the most important. First, investors are bearish while S&P 500 is at all-time high. Second, there is $7 trillion of cash on the sidelines. Third, this is a further sign that the bull market of 2023 to 2024 continues. Okay, now we need to move on to Tom Lee's latest picks. So he just added 4 new ones to his super SMID grannies list. Now, if you don't remember, SMID grannies are long-term opportunities in the small and mid-cap universe, positioned to benefit from at least 2 strategically or tactically important macroeconomic or secular tailwinds. And just for context here, I mean, the reason you should care about these is because historically they perform. SMID grannies outperform the S&P 500 by a lot and the Russell 2500 by a lot as well. So make sure to pay attention to these. We've covered so many of these since he started this list, and quite frankly, so many of them have done very, very well. So what are his latest picks? Well, Hims has carried over, and then you have AppLovin, Spotify, Interactive Brokers, and Carvana. Hims has been a very, very big play of ours as well and has performed astronomically crazy over the last couple of months. And then all of a sudden, the last maybe 48 hours, you're seeing a major sell-off. Now, obviously, we've been warning that, hey, yeah, this is what happens after you get unrelenting bull cycles. And again, I said that this was a $70 to $80 stock, and obviously lots and lots of people took tons of profits at the top. But you also have to understand that now that we're down, you're starting to get into another opportunity where you can start snapping up some dip buys. You just got to dip buy and then be patient. So why is it going down right now? Well, for a while, Hims had been making some serious cash by offering compounded versions of GLP-1 weight loss drugs like Ozempic and Wegovy. Why? Well, because there is a supply shortage and the FDA was cool with compounders stepping in to fill the gap. But now the shortage is apparently over, and the FDA just came out and said, all right, playtime's over, no more compounded versions, which obviously wasn't such good news for Hims. That means that Hims is going to be losing one of its big revenue drivers, and traders are panicking. But let's be real, when Wall Street hears revenue risk, they hit the sell button first and ask questions later. And also, a lot of traders were in Hims purely for the hype, and when a stock runs up some 300% in a few months, obviously you're going to attract FOMO traders and momentum algos that are going to be the first to sell out. But here's the thing, Hims also reported earnings in the after hours today, and Hims is absolutely killing it. We have declared over and over again that this is a $70 to $80 stock and that member growth and monetization of the members have supported that conclusion. And today, Hims reported an earnings report that completely backs that up. But at the same time, people that are in this are like, well, wait a second, this ran up so fast that where is the upside after $70 to $80? There's just not as much upside anymore, and then you have this negative short-term headwind with the whole weight loss drug thing. So people are like, okay, I'm going to lock in some profits and I'm going to play the next run. In the view of Tom Lee, Hims is still a long-term growth story. It's one of Tom Lee's SMID grannies, and it has big secular tailwinds, strong customer acquisition, and a solid reoccurring revenue model. So in the short term, look, you're going to see a chop fest. It's selling off. There's opportunity in the sell-off, and quite frankly, I mean, if Hims continues to outperform and execute, you're going to see the prices go much, much higher than $70 to $80. Dip buy opportunity, I agree with Mr. Tom Lee. Okay, let's talk AppLovin. So why AppLovin? AppLovin runs one of the most advanced AI-driven ad platforms, and digital ad spending is only going up. Companies are pouring billions into automated AI-driven ad placement, and AppLovin is at the center of this shift. The mobile gaming sector is a cash printing machine, and AppLovin's tools help developers maximize ad revenue. AppLovin has a huge competitive moat in mobile game ad monetization, and it is a high margin business model with massive revenue potential from expanding ad budgets. Okay, let's talk about Spotify. Why Spotify? Let's face it, no one is listening to FM radio anymore. Everything is on-demand streaming. Spotify is the dominant player in this space, and the shift towards subscription-based content is a major long-term driver. Spotify isn't just music anymore. It's investing heavily in exclusive podcasts, AI-generated playlists, and audiobooks, making it a one-stop shop for all things audio. This differentiation is key to subscriber stickiness. This is a recurring revenue model, and it's highly scalable, and it has expanding profit margins. The next one is Interactive Brokers. More people than ever are trading stocks, using options, and getting into futures and forex, and Interactive Brokers caters to serious traders who want low fees and advanced tools. As more international investors enter the market, there's increasing demand for sophisticated platforms like IBKR, and this might be a granny shot pick for the simple reason that this is a platform for high net worth investors and active traders. It has expanding margins as users flock to low-fee, high-tech brokers. And then he has Carvana here, the e-commerce disruptor for cars. So more consumers are buying used cars online, and Carvana has a first mover advantage in digital auto sales. The used car market has been a mess for the last few years, but supply chains are normalizing, and AI-driven pricing tools are helping Carvana maximize profit per sale. Consumers like myself prefer convenience, and Carvana's seamless online model makes car buying a lot easier. I've actually used them myself to buy something a few years back, and they were pretty easy. I don't think they give you the best deal in the world, to be honest with you. But hey, you know what? That's more profit profit for the company, right? AI pricing tech gives it a competitive edge over legacy dealerships. So anyways, folks, Tom Lee isn't just picking these stocks because they look cool. No, they fit his granny shot strategy because they're riding two or more powerful trends. But now it's time to move over to our main entree, one stock that Tom Lee has been highlighting again and again, and that's Palantir. Palantir is our beautiful play that went up about 18x from our video begging folks to buy in at the $7 region, but it's now been falling. The stock has gone from 125 down to the low 90s. If you've been with us the last few years through bull and bear cycle, you know this stock goes up a lot, but also falls a lot because that's just how this business is. And I'm a big believer in the idea that when you're in an unrelenting, unbreathing, restless momentum cycle, well, eventually your stock will find a reason to sell off. And we said this right before Palantir did this sell-off, right? But a big alleged reason for this sell-off is the Pentagon is trying to cut 8% of their budget, alongside many other government agencies that are trying to cut out the fat. And since Palantir's business is around 50% government, well, that means that on first glance, people will think, hey, that means that Palantir is on the chopping block. The Trump administration and the DOGE agency want to make government more efficient and more productive, and people think that Palantir is going to be cut, but you got to remember that cutting the most effective productivity provider in government doesn't make sense. And that's why Tom Lee is actually suggesting that hey, if you're a government contractor or IT consultant that overcharges the government, well, you're about to be screwed. But if you're someone that provides for productivity, specifically Palantir, well, this is actually a big positive for you. The CEO of Palantir himself has said that Doge is very, very good for them. And the irony is that a lot of the folks who were accusing Palantir of being a heartless profiteer from Trump's policies are now saying they are going to be hurt by Trump's policies. It's all just noise, folks. It doesn't make any sense. The fact of the matter is, folks, bigger picture, the 21st century battlefield is increasingly AI, and if you remove Palantir, you're losing the battle, full stop. So anyways, eventually Palantir will have bigger sell-offs because that's how growth stocks trade, but bigger picture, this stock is a winner, and I would use the sell-offs as an opportunity to dip buy, and that is what Tom Lee is suggesting very heavily. Anyways, that caps off today's video. Make sure to take advantage of our Palantir 75 coupon code before it expires, and we'll see you in the next video.